On Business Incorporated today. World Bank warns Nigerians of exceptional squeeze in coming months. Foreign currency deposits in Zimbabwe local banks grow. International Monetary Fund sees Gambia growth flat following Russian invasion in Ukraine. Hello and welcome to the very first episode of Business Incorporated on Channels Television, the first for this week. I'm Ini John Mekwa. Well, let's check out what's happening in major markets in Africa. We see that trading sentiment were mostly negative at intraday. Nigeria's main index was the only gainer. It was up 0.19%, while South Africa's index dropped 0.23%. Elsewhere, Egypt's equities market stumbled as intraday its index was down 1.55%, and Nairobi Stock Exchange ended Friday's trading session also in the negative territory. We move to the Middle East now, where major equities were trading in the green as a flip of what's going on in Africa. Abu Dhabi and Dubai's indexes were both up 0.72% and over 1% each. Still within the region, Saudi Arabia traded higher by 0.8%, while Qatari index gained 0.12% as intraday. In Europe, European foreign ministers are meeting in Luxembourg to discuss new support for Ukraine, as well as possible new sanctions against Russia. On the agenda, further measures against Russia energy, in particular oil. Well, we have Stephen Birdsley now from Dr. Werler in Berlin joining us now for more. Hello, Stephen. So what should we expect, or what can we expect from this meeting?
Well, discussion on energy sanctions is just one part of the agenda, another part being providing more financial help for Ukraine in the weeks ahead. But of course, those energy sanctions, discussion of them is going to really steal all the headlines in the weeks ahead. And that's because the EU is really seen to have broken a taboo last week when it approved coal sanctions. And there's a lot of enthusiasm amongst some countries for going further with oil and gas. It's unclear how far it will get in the coming weeks. And there's several reasons for that. One is that the French presidential elections, the final round is 2 weeks from now. And of course, inflation, that is rising costs, have been already a big issue in that race. And if there is an import ban on anything further, such as oil or gas, that would probably push prices much higher. The second reason is that there's already clear opposition from some countries, Germany standing out amongst them. So let's keep in mind the background for this further discussion is that there's an expectation that the war is going to get worse in the weeks ahead as Russia gears up for a campaign in the east. We've also seen the ruble improving, I should say, in terms of value. So some of those sanctions not really working as hard as thought in the long term. And then there is that taboo that the EU broke last week and the expectation that perhaps they could go further. So with all these things sort of mixing together, it's unclear exactly what's going to happen, but the discussion is going to come up.
Yeah, but there seems to be opposition in bringing up new sanctions, especially when it comes to energy on Russia.
Well, Russian oil accounts for about a quarter of oil imports in the EU. But for some countries, such as Germany and Hungary, for example, they account for much more than that. And those two countries are both opposed right now to banning oil imports because one of the questions is, where are they going to get replacements? Another is, and this would go for, this would be the same across the EU bloc, is it's likely to push up prices, and not just on energy. Gasoline prices have already risen in recent weeks just because of the effects of the war. They could go up even further if that Russian oil is taken completely off the European market, and then Europe has to search elsewhere for its oil. OPEC also has not increased output in recent weeks, so there isn't really much slack to take up there. That also feeds into food and goods prices, and that's something that people across Europe are already seeing. So there's a bit of a reluctance to put even more pressure on people when it comes to how much they're paying.
All right, and then we also have the markets. What can we expect from markets in Europe?
We're going to expect some of the similar pressures from the weeks ahead. There's, of course, everyone trying to understand what the monetary policy tightening in the U.S. is going to mean across global markets. But here in Europe, markets are especially reacting to a couple of factors. One is the first round of the French presidential elections, which occurred yesterday, and Marine Le Pen coming in second. Now, Macron did better than expected, but Marine Le Pen still is seen as having a very good chance for the second round with the way things are aligning. So that is playing out in markets. We've seen them drop in Paris. We've seen them drop also in Berlin and in London, where there's been recent new figures given to the UK economy and showing that a lot of growth has stagnated there. And so that's also causing some concerns that's weighing on markets. And then, of course, the further course of the war is a big concern across Europe. There is, as I've said, an expectation that things are going to get worse in the weeks ahead. So that's also weighing very much on markets.
All right. Thank you so much, Stephen, and enjoy the rest of your day. Well, talking about the UK economy, we are going there next. February GDP came out lower than expected for February, noting that the war in Ukraine started on the 24th of February. Well, I wonder how much of that can be connected to the Russian invasion, where we have Juliana joining us from our London studios now to tell us more about that. Good afternoon, Juliana. Well, Chancellor Rishi Sunak has been reacting to the GDP figures. What's he saying, and what's there to talk about, really, about recovery and other related issues?
Good afternoon, Innie. Well, unfortunately, the only sound bites we're getting from the Chancellor are to do with his own personal finances, which is a huge storm currently engulfing number 11, vacant number 11, because his family have moved out after the press found out that his wife held a special non-dom status. Let's put that aside for a moment, because I'm sure we're going to be discussing that much more in the week. And as you said, GDP figures pretty disappointing, coming in at just 0.1% growth for the month of February. As you said, yes, the invasion of Ukraine did take place on the 24th of February, but if you consider there were only 4 days left and 2 of them were at the weekend, sadly, for the Treasury at least, this downward spiral cannot be attributed to that. What economists are putting this down to our supply chain constraints. We know that even though in the UK restrictions were lifted during the month in February, in China lockdowns did start to resume. This was weighing heavily on supply chains, which had a knock-on effect on manual and construction and production, particularly of car production, which we know already is suffering from a severe slowdown because of the semiconductor chip shortage. We also had extremely bad weather. I'm sure you'll remember, Innie, us discussing some of those storms that were battering the UK. That had a significant impact on the housing sector. And, of course, we can't forget health. Now, lots of big companies were making lots and lots of money of test and tracing and COVID-19 tests. Any of our viewers in the UK wouldn't have to walk far to see one of those big tents taking tests for people that want to travel. Of course, they've now almost certainly gone out of business, and that's had a knock-on effect on GDP. So there are some concerns, because we know that we're looking in the rearview mirror. There are still headwinds to come, and especially if you are in the UK and you're hearing that there's a cost of living and a big squeeze, are you going to be going into your purse for that extra splurge? That's exactly what the economy needs, but I don't think that's going to be happening anytime soon.
Yeah, not happening in a lot of countries in the world at this time, Juliana. Well, how's the market reacting to this?
Not great. The FTSE started off the week in the red. It's very much in the red at intraday. The FTSE All Shares down at the moment by 0.40%. The FTSE 100 also down by 0.42%, and the FTSE 250, the domestic market, that's down by over 0.25%. In the currencies market, the British pound is down on the US dollar by 0.07%, also down on the euro by 0.32%, but the British pound is up on the Japanese yen at intraday by 1.01%. Worth mentioning, Innie, that we discussed last week, the UK airline situation. Again today, over 100 flights have been cancelled out of Britain's 2 busiest airports, Heathrow Airport and Gatwick Airport, and it's come at a time where, of course, families are really eager to get away for Easter, but sadly many of them haven't been able to, which is why British Airways and EasyJet are one of the biggest fallers on the FTSE today.
Oh, thank you so much, Juliana. A lot of reds in the market there. Well, what's the outlook for the week? What else what figures are we expecting this week?
Busy data week this week. It's a short week, of course, because Friday is Good Friday, so the markets are closed. But tomorrow we are getting unemployment data. The labour market in the UK has been actually quite robust, considering there were screaming headlines saying that millions of people would be out of jobs. That's not the case. So we're expecting tomorrow unemployment to fall once again to about 3.8%. And then, of course, everybody is going to be waiting for the inflation data. We're getting inflation data in America this week, which we're expecting to come in at 8%, and then we get our own domestic inflation data. We're expecting it to possibly rise to about 7%. It's currently 6.2%, but it could be much higher than that. Hopefully not double digits, but if you're buying a coffee in London at the moment, it does feel like it's double digits because they're rising by between 50p and a pound. So people are certainly feeling the pinch, but we'll just have to wait and see what the Office for National Statistics tells us.
Wow, that's scary. Just the coffee one painted a picture there. Thank you so much, Juliana. Enjoy the rest of your day.
Thank you.
Let's go to Asia now. Chinese stock led losses in Asia-Pacific markets as investors react to China's inflation data for March and monitor the COVID situation on the mainland. Mainland as well as Hong Kong stocks have been tumbling all day, but losses deepened by Monday's market close. The CSI's 300 index, which tracks the largest mainland listed stocks, fell by over 3% to 4,100.07. Shanghai Composite was down 2.61% to about 3,167.13, while the Shenzhen component tumbled 3.67 to 11,520.21. Hong Kong's Hang Seng index closed over 3% lower at over 21,000. Hong Kong listed shares of Chinese electric vehicle maker NIO plunged almost 12% after the firm announced a suspension in production. That's because of disruptions at the supply chain partners as a result of the COVID outbreak. Elsewhere, the Nikkei 225 in Japan slipped 0.61% on the day to 26,821.52, while the Topix index shed 0.38% to almost 2,000. South Korea's Kospi dipped 0.27%. Australia's S&P AX 200 bucked the overall trend regionally as it climbed 0.1%. Finishing its trading day at almost 7,500. MCSI's Broadex Index of Asia-Pacific shares outside Japan is slipped more than 1.5%. In the United States now, stock futures were mostly lower in early trade as Wall Street looks to shake off a losing week. Futures tied to the S&P 500 dipped almost 0.5%, and Nasdaq 100 futures almost slid almost 0.9%. Dow Jones Industrial Average were flat. Those moves came as U.S. Treasury yields continued their upward trek following a Friday jump that saw the benchmark 10-year yield hitting a 3-year high. The yield on the 10-year Treasury note sat at 2.75%. Yields move inversely to prices, and 1 basis point is equal to 0.01%. Wall Street is coming off a negative week, with the tech sector being a source of concern. The tech-heavy Nasdaq Composite fell 0.9% last week, while the S&P 500 and Dow dropped 1.3% and 0.3% respectively. The healthcare sector was a bright spot. It gained more than 3%. The fight against inflation is likely to be a market driver this week. Investors will get a look at fresh data, with the Consumer Price Index for March should be out tomorrow, and Producer Price Index should follow on Wednesday. Well, later this week also, the first quarter earnings season will hit its stride, with JP Morgan Chase and Delta set to report results on Wednesday. We'll take a break now. When we come back, we have more stories for you, focusing on the African continent. To stay with us, this is Business Incorporated on Channels Television. Welcome back. You're still watching Business Incorporated on Channels Television. We turn our attention to Africa, starting with Nigeria. The World Bank has predicted tougher months ahead as household real disposable incomes in Nigeria are expected to face an exceptional squeeze. Well, the World Bank director in Nigeria disclosed this in Abuja and indicated that COVID-19 crisis in the country increased the pre-existing structural distortions, which includes trade distortions such as 2019's border closure, driving up prices and eroding purchasing power before the pandemic. This in turn has brought about near stagnation in household real disposable because they have preceded the exceptional squeeze, which is expected this year. And still in Nigeria now, our non-oil export for 2021 stood at 4.194 trillion naira, and that shows almost 40% drop in 10 years when compared to 6.91 trillion naira non-oil export recorded in 2012. In 2012, Nigeria's total export amounted to 22.446 trillion naira. Out of this number, 15.53 trillion naira was crude oil exports, while 6.914 trillion naira was non-oil exports. And this brings up a lot of questions, some of which we expect that Mr. Shuaibu Idris, the Chief Executive Officer of Timeline Consult Limited, will speak to. Good afternoon, Mr. Idris. Good to have you on the program.
Good afternoon, Ini. Thank you for having me.
So there are some concerns that in spite of several government policies to boost non-oil exports, we're seeing a decline in the amounts that we have for non-oil export. What really, from your perspective, do we need to do? What are we missing out?
I think fundamentally there are two issues to look at. Number one, in the last 5 to 10 years that have passed, we've had incessant insecurity challenges, tribal clashes, intertribal clashes, religious bigotry, as has been the case, mostly in the hinterland, the northern part of the country, where you have this endemic challenge of insecurity. Secondly, if you look at what has happened in the supply challenge that has faced farmers, particularly fertilizer issues, you will also have a reason why the agricultural produce, or if you like, the non-oil export, will largely come down. Prices of fertilizer has been relatively on the high side. Even when it is so expensive, it is seldom available as and when it is what is required. And even when and where it is given, it is insufficient. So you have a tripod of a challenge as far as fertilizer is concerned. High prices, untimely delivery of the produce, and also the lack of sufficient quantity in terms of what the farmers are demanding.
So when we talk about fertilizer, recently we had the official opening of the Dangote facility. Do you see that dealing at least with the challenge of fertilizer?
I think it will significantly reduce the challenge, but you have to understand that the Dangote fertilizer factory will be producing uranium. You will be producing a part of fertilizer that is not necessarily demanded by all the farmers. So urea, which is what they will produce, and ammonia, which is another produce from the Dangote fertilizer, are not sufficient fertilizer for farmers. There are other types of fertilizer that is required that the Dangote refinery, or Dangote fertilizer rather, will not be able to produce.
So apart from, okay, you also talked about the supply chain constraints as one of the challenges in the agricultural sector, and I believe that will include like infrastructure, transportation, and all that. But we've heard a lot of efforts by the government, even in this area, to not just produce, but also to get it out. Would you say that issues such as a ready market, maybe if the government was ready to take off some of this produce from the farmers, from the point of production, that is from the farms, do you see that as a possible solution to this?
Well, we've never lacked policies and assistance from government. Yes, there has been supply or logistics challenge, but government has been there coming in with subsidies such as export expansion grant, which is expected, or which was started from 30 years ago, with a view to helping exporters to get a cushion and be able to be competitive internationally. But you see, the major challenge Nigeria has is the near absence of coherency or integration of the policies. There has been researches and researches and researches from the Ivory Coast, the University of Nigeria, where those research are turned into government for possible implementation. Science, technology, and innovation was supposed to have been used to improve our agricultural output and production processes. But what has government done with such studies? Near nothing. So you realize that even as recent as 3-4 months ago, the Federal Minister of Agriculture came in with a policy of, say, we want to improve the number of tractors that are being used in Nigeria. When you dimension the agricultural landscape of Nigeria and the number of tractors that you have, these are laughable figures. So yes, there has been some level of assistance from government, like I did say, in terms of export expansion grant. But what has been, the contribution again from the private sector arising from, the gift that government gives its exporters? We are supposed to be seeing an improvement in the processing facilities that we have in Nigeria, at least on some of these agricultural produce. Why should we be, for example, exporting raw ginger? Why can't we add value to the ginger? Why should we be exporting raw sesame seed? Why should we be exporting raw cashew nuts? The exporters need to do something in addition to what the government is doing. So there is need for a holistic approach if we are to see an improvement. But a decline of 40% in 10 years, to say the least, is criminal, because we shouldn't be experiencing this much of decline despite the efforts of government. I do agree that the institutions are challenged would have contributed. I do also agree that the near absence of sufficient logistics and supply chain mechanism in Nigeria would have contributed. And indeed, the post-harvest losses that these farmers experience will all have contributed to this abysmal performance. But be that as it may, both the private sector and the public sector needs to have an integrated approach so that we can see a bit of an improvement in our performance.
All right, Mr. Idris, thank you so much. Integrated approach. And thank God you also noted some of the possible challenges which the private sector, or which seems to be deterring the private sector from adding value to our raw materials. A lot of work to be done there. Thank you so much, Mr. Shoaib Idris, the Chief Executive Officer of Timeline Consults Limited. And quickly, let's just go to Zimbabwe, where foreign currency deposits in local banks continue to increase in a development indicating growing confidence in the country's banking sector. Statistics from the central bank shows that foreign currency deposits grew from an equivalent of 103,000 billion Zimbabwean shillings to comparative period to 210.7 billion. And just before we go in, Gambia, IMF is saying that Gambia's growth flatlining in 2022, given Gambia's economic growth in 2022 is forecast to be unchanged from last year, as the central bank is likely to tighten policy to contain price pressures emanating from Russia's invasion. The West African economy has seen expanding 5.6% this year after rebounding to a level in 2021 from the pandemic-induced low levels. Gambians have gone to the polls to vote for 53 legislators on a 5-year term, with the president speaking 5 orders. About 40 Economic Community of West African States observers are deployed across 7 administrative regions to monitor the election. Well, that's it for today. Thank you so much. It's just the first. We have 4 more to go. Let's do it again tomorrow. I'm Ili John Mekwa.